Guys, this is S&P 500 weekly technical analysis for the week of March 27th, 2023. That is from March 27th, Monday to March 31st, Friday. Now, the previous week, it was a very heavy volatile week. There was a very heavy volatility in the previous week. And that has resulted in unexpected upward movement and then a sudden fall. Then again an upward movement, then a fall, and then upward movement. But this was no surprise, as we knew that the previous week, it will be very heavy volatile because of the FOMC, because of the press conference of the Fed chairman and the mayhem in the banking sector. In my previous S&P 500 weekly technical analysis, I mentioned this thing that when this thing happens, when the volatility comes into the picture, high or the heavy volatility comes into the picture, then we can expect an upward movement up to the zone of 4035. And whenever there comes a downward movement, if the downward movement comes after the upward movement or if it comes before the upward movement, then also we can expect that the downward movement, it should be limited to the zone of 3840 to 3790. However, there are very good chances or very heavy chances that it can further come down. It can even breach 3790 and it can come down to 3630. But in the bullish side, we have 3991. As such, a breach of 3991 is not possible. But if there comes more than expected volatility, 21st, 22nd, then yes, then a breach of 3991 is possible. In that case, it can move up to the zone of 4035. So as of now, even in the expected or unexpected scenario, 4035, it will be able to handle the upward movement. So these were the updates on March 22nd. Okay, I've given to my YouTube community members. Okay, so I will cover all of these updates, and then I will tell you that why there was a sudden upward movement and then there was a heavy fall, 2.5% fall within a day. Or sorry, not actually within a day, but within half an hour, within 30 minutes only. So the market manipulators, they have built a bullish trap here on Wednesday, then they have built a bullish trap here on Thursday, and then finally it came down, and then in the second half it moved up and it closed around the levels where it might look bullish. However, it is not bullish, it is bearish. So I will cover this section in this the S&P 500 weekly technical analysis, that why it is bearish even though it looks bullish. The other thing that I mentioned in my previous S&P 500 weekly technical analysis, so yes, we were not sure that what kind of movement will be there. But there was more than 90% probability that this will happen. This is what we knew with more than 90% probability, that no matter what, even if it moves up, then also it will come down, no matter what. This thing was very, very clear. Any bullish retrace is an opportunity to go bearish no matter what. So what did we miss here? I have missed 0.40% movement on Tuesday. However, on Wednesday, we knew that this can happen. This was there. Then on Thursday, we have again missed a 0.4% movement, okay, because it was expected to remain below 3931. 3931, it was the resistance level that was supposed to hold. However, it breached and it moved up by 0.40%. Okay, that was missed. Otherwise, okay, this movement, it was all as was predicted and expected. Anyways, the previous week, the movement was like 75% to 80% as was predicted. Okay. Now let's see what is going to happen in the coming week. Now, guys, we are going to discuss the agenda of this S&P 500 weekly technical analysis. That is for the week of March 27th, 2023. That is from March 27th, Monday to March 31st, Friday. So the first point of the agenda of this S&P 500 weekly technical analysis is the S&P 500 technical analysis on the weekly chart. So weekly chart means the Hawkeye view, the big picture, what is going to happen in next like 1 quarter or 4 months or 6 months and 2 months, etc. The big picture. So last week I mentioned this thing that any bullish retrace, any good bullish retrace is an opportunity to go bearish. No matter what, it will come down. No matter what, it will come down. Okay. The reason was that through the weekly chart, okay, it is confirmed that the S&P 500 is in the long-term bearish trend. Okay, so this the upward movement, then a fall, upward movement, then a fall. This was because on this the bigger chart, the S&P 500 is bearish. That is why it is always advisable to go with the trend, because the trend is bearish. This means that a bullish retrace is not an opportunity to go bullish. No, it is an opportunity to go bearish. Okay, so we will look into this, the weekly chart, the Hawkeye view, what is going to happen in and what is this is the big picture, and what has changed and what has not changed, etc. Okay. Then comes the second point of the agenda of this S&P 500 weekly technical analysis. And this the second point is the recession, FOMC, and the press conference of the Federal Reserve Chairman. So this was my 10th update on March 22nd to my YouTube community members. And I mentioned, he just said that we don't know whether the recession will happen or not. And this has changed from his earlier comments, where he used to say recession is not happening or out of the picture, right? So now in his recent press conference, he has first time he has accepted. So indirectly he has accepted that yes, now the chances of seeing recession are there. Earlier, he always used to deny this fact that no, the recession is not there, and there might be a correction, but the recession will it will not be there. So this was the first time he has admitted. So we will look into his comments, the comments of the Federal Reserve Chairman. Okay, these comments, all of these are comments that I've given to my YouTube community members, and these comments will clear you the picture that why there was this upward movement, a premature celebration to form a bullish trap, and then intraday in just 30 minutes 2.5% fall, and then again a bullish trap, then again a fall. Okay, so this was all because of this the press conference of the Federal Reserve Chairman. So we will simply decode the press conference of the Federal Reserve Chairman, and this the FOMC and its comments on the recession. Then comes the third point of the agenda of this S&P 500 weekly technical analysis, and the third point is the S&P 500 support and resistance levels. So in my previous S&P 500 weekly technical analysis, so I mentioned this thing, the zone of 4035, okay, in an exceptional scenario, otherwise 3991. Then below, then we have 3937 zone, oscillation between, okay, these levels up, down, and then downward movement to 3840 to 3790, etc. So these were the support and resistance levels. And if you notice that in the previous week, the movement of the S&P 500, okay, it was within, okay, this the range. Similarly, okay, for the coming week, I will give you the support and resistance levels, okay, for this the S&P 500, and I will tell you that where we are expecting the S&P 500 to move, where it can move, what are the chances of moving up and down, and what will be the levels, support and resistance levels, etc. Then comes the fourth point of the agenda of this S&P 500 weekly technical analysis, and the fourth point is the S&P 500 technical analysis on the daily chart. See, this was the weekly chart. Weekly chart means a big picture for like 1 quarter or 2 quarters. Okay, that what is going to happen? What is the big trend? Okay, the big trend. But on this the S&P 500 technical analysis on the daily chart means we are going to see that what the technicals are saying on this the daily chart. And surprisingly on Friday, okay, see, there is one more thing, that even though, okay, it looks bullish, okay, you can clearly see that, okay, it is a bullish candle, okay, and it looks bullish, but it is not bullish, it is bearish. So this has happened on the Friday itself. There was a change in the stochastic RSI, and that change is now aligned with the bearish trend. So I will do the technical analysis on the daily chart, okay, and we will see that what is expected to happen in next 1 month, okay, 1 to 2 weeks, 2 to 4 weeks, etc. Means this is the very near or this is the very short term picture. Okay, weekly chart means the long term picture, right? So combining the weekly chart and the daily chart, we will come to know what exactly is happening. And that is the reason, okay, through, okay, all of these, the support resistance levels, weekly chart, daily chart, okay, we are able to achieve this a very high accuracy in the movement, okay, and whenever there comes a deviation, then that deviation is like 0.2% to 0.5%, okay, at max. Otherwise, the movement of the S&P 500, okay, is as per our expectations. Then comes the fifth point of the agenda of this S&P 500 weekly technical analysis, and the fifth point of the agenda is the probable movement of the S&P 500 for the week of March 27th, 2023. That is from March 27th, Monday to March 31st, Friday. So we are going to see how exactly the S&P 500 is going to move from Monday, Tuesday, Wednesday, Thursday, and Friday. Means until Friday. Friday is March 31st. So I will tell you that how exactly the S&P 500 is going to move until March 31st, 2023, Friday. Now guys, there is one more thing, that this S&P 500 weekly technical analysis might be a bit lengthy. That is why I have created the sections in this S&P 500 weekly technical analysis, so that whichever section you want to watch, you can watch. Whichever section you want to skip, you can skip. Whichever section you want to rewatch, you can rewatch. So it is just for your convenience. However, I strongly recommend to watch the entire S&P 500 weekly technical analysis, because each and every section is linked to the other section. And this S&P 500 weekly technical analysis contains a tons of information. So this is the disclaimer to this S&P 500 weekly technical analysis, that this S&P 500 weekly technical analysis is not a financial advice of any kind, in any form or in any manner. This S&P 500 weekly technical analysis is not about any trade setups. So whether you are making 500, 600% profits or 2,500% profits within a day, or you are seeing 10, 20% losses within a day, all of these, the profit and losses are all yours. Because I do not know how exactly you are going to interpret my S&P 500 weekly technical analysis. However, I try my level best to clear each and everything, to clear each and every point. But still, I do not know how exactly you are going to interpret my S&P 500 weekly technical analysis. So guys, if you have not yet subscribed to my YouTube channel, then please subscribe to my YouTube channel and click on the bell notification icon. Now guys, I am going to begin with the first point of the agenda of this S&P 500 weekly technical analysis. And the first point is the S&P 500 technical analysis on the weekly chart. So let's move on to the weekly chart. Now guys, we are here, and this is the first point of the agenda of this S&P 500 weekly technical analysis. So in this, the first point of the agenda, I will do the S&P 500 technical analysis on the weekly chart. Let me write it down. Weekly chart. W as in weekly. So when I say the weekly chart means that the one candle represents 1 week, not 1 hour or 1 day, okay, or 1 month. One candle means 1 week. As simple as that, right? At first, okay, it comes the candle. Okay, it comes to this, the candle. When you look into the candle, it's a bullish candle. Yes, it's a bullish candle. However, if you look into the body of the candle, it moved up, came down, closed around this the 50% level. Okay, so this says that there are some bullish sentiments. Some bullish sentiments. That's it. Nothing else. Nothing else. Simple. So what it means by the some bullish sentiments? Some bullish sentiments means that in the next week, early like Monday or Tuesday, okay, we can expect, a little bit, okay, there's the upward movement, okay, that's it, but not a heavy upward movement. A little bit upward movement because there are some bullish sentiments, okay, that's it. When I say a little bit upward movement, so that upward movement is again like 3991. Okay, and on this daily chart, we will see that there is also a 200-day EMA. Okay, that is around 4,000 or 4,002. Okay, in an exceptional case, otherwise 3991. Okay, so some bullish sentiments. That's it, nothing else. Now the technical indicators will clear the picture that what it means by the some bullish sentiment. Now first comes the Bollinger Bands. This is the lower band of the Bollinger Band, and this is the median of the Bollinger Band. Because the S&P 500 has closed in between the lower band and the median of the Bollinger Band, this is why S&P 500 is clearly bearish through the Bollinger Bands. Then comes the Ichimoku cloud. If you look into the Ichimoku cloud, S&P 500 has closed below the Ichimoku cloud. This means that now the S&P 500 is clearly bearish through the Ichimoku cloud, right? Now comes the moving averages, the EMA. Now if you look into the moving averages, EMA, so what is happening is that only by $1, okay, the moving averages are bullish. Only by $1 means not bullish, but are in the bullish pattern. Only by $1 the moving averages are in the bullish pattern. Only by $1. That's it. Okay. However, surprisingly, the closing of the weekly candle of the S&P 500 was below these the moving averages, and this means that through the moving averages, S&P 500 is neutral. If the S&P 500 would have closed above 3972 or 3973, in that case, there would have been a bullish support through the moving averages to the S&P 500, but now that is neutral. Okay, just by $1, just by $1. Okay, again $1, just by $1. So you can clearly see. So there is a manipulation technique. Okay, if you have watched my the manipulation, okay, these the videos on manipulation, then I clearly mentioned that there is a manipulation technique, and we call it as mark the close. Mark the close. So most of the times the market movers or the market manipulators, they willingly close the stock market or a particular index or a particular stock at at some price where it might look bullish but it will be bearish, or it might look bearish but it will be bullish. Okay, means it will be very, very confusing, right? Anyways, now let's talk about some other technical indicators. So yes, the good thing that has happened finally, 1.96. Yes, the good thing that has happened is that the MACD is now bearish, because the MACD is finally less than the signal. Until last week, until the week of, okay, that was March 13th, last week, okay, it was MACD was bullish, and because of that thing, because of that bullish MACD, the stock market and the S&P 500 was able to hold its bullish position. Okay, however, this time the MACD is less than the signal. Okay, now this is the very first thing that says that this clearly says that through MACD, S&P 500 is clearly bearish. However, this is not the end of the story. Okay, the best part of the story is the stochastic RSI. The K channel is less than the D channel. K channel is less than the D channel. Means the stochastic RSI, means the S&P 500 is bearish through the stochastic RSI. And once again, if you have subscribed to my YouTube channel for last many months or years, I've repeatedly mentioned this thing, that whenever the MACD and the stochastic RSI are in the same direction, that direction, okay, it becomes the direction of that particular index or the stock or the stock market. In that case, in this particular case, both MACD and the stochastic RSI both are bearish. Both are bearish, and also the Bollinger Bands and this the Ichimoku is bearish. Okay, means mostly all of, or not mostly, but almost all of the technical indicators are saying bearish. So this is the trend. This is the trend. I'm talking about the trend. Now this is the trend, right? So this was now I guess one or two more, minimum two more bullish candles are needed. If there comes two heavy, sorry, not bullish candles, if there comes two heavy bearish candles, okay, then after in the mid of April 2023, we can see the saturation in the stochastic RSI, and then only we can expect a technical reversal. Okay, otherwise still there is good room. Okay, like two heavy bearish candles can come, not two but three. Okay, it depends on the movement. Anyways, then comes the divergence is normal, and saturation, volatility, etc. Everything is fine. Okay, everything is normal. Now this clearly means that there is no change in that trend. Clearly no change in that trend. Okay, so what you have noticed is that technicals, S&P 500 is bearish through the Ichimoku cloud. S&P 500 is bearish through the Bollinger Bands. S&P 500 is bearish through MACD. S&P 500 is bearish through stochastic RSI. S&P 500 is neutral through the moving averages. This means that this is the big picture. Big picture is that the S&P 500 is 90% bearish, 90% or more than 90% bearish, clearly bearish. The heavy bearishness is coming through the MACD and the stochastic RSI. In the next week, if there comes a small bullish candle or a red candle of any kind, a red candle, then there will be a confirmed, almost a confirmed crossover in the moving averages, and then there will be a 100% absolute bearish trend in the S&P 500. But as of now, what you can notice is that, okay, let me show you this, the picture. Okay, what you can clearly notice is that it came down, move up, came down, move up, then down, up, and then down. Okay, so this is the natural flow of the stock market. Okay, or this is the natural flow of any index. Okay, or of any stock. Okay, now this is also confirmed through the these are technical indicators. Okay, so this, what it means, it means that the bigger trend, okay, the big picture is the bearish picture. It is, the trend is bearish. This means that no matter what, whenever it try to move up, it will come down. It try to move up, it will come down. Okay, this is the big picture. Okay, and also guys, let me tell you, one more this thing. Okay, what happens is, generally, okay, this is the pattern. Okay, this is a pattern, and the pattern says one heavy candle, okay, second counter candle, third counter candle, fourth counter candle, something like this, and this. Okay, this kind of candle. So this pattern, okay, it is rarely seen. However, this pattern, okay, it's a beautiful pattern. So this time I'm heavily suspecting, okay, this kind of pattern, because of the bearish trend on the weekly chart. A confirmation of this, the bearish trend, particularly through the MACD, okay, which was earlier bullish, but now it is bearish. And now, even if the MACD, okay, even if it has to go bullish, then also it will take at least 1 month. Okay, 4 weeks, around 4 weeks, because MACD on the weekly chart, okay, you will never notice that it is changing very frequently. Okay, as early as like 3 to 4 weeks it will take to change the values. Okay, otherwise it will not change. So sometimes it will be there for months, 3-4 months, 1 year or so. Okay, so this was a recent change, and this was the same thing I mentioned to my YouTube community members yesterday in my final update. So guys, once again, if you have not yet subscribed to my channel, then please subscribe to my YouTube channel and click on the bell notification icon. And if you want to get the daily analysis and the daily updates of the S&P 500 from Monday through Friday, as well as the stock market opportunities 5 to 10 every week, then you can join my YouTube community. I have given the link in the description of the video and also in the comment section. Now guys, let's move on to the second point of the agenda of this S&P 500 weekly technical analysis. And the second point of the agenda is the recession, FOMC, and the comments of the Federal Reserve Chairman. So we are going to decode what exactly he has said, okay, and what was the meaning, okay, of his words, okay, what was okay, about the tone, positive or the negative tone, and what the market manipulators, they don't want you to know. So guys, now we are here, and this is the second point of the agenda of this S&P 500 weekly technical analysis, and we are going to decode what the Federal Reserve Chairman has said, okay, in his press conference, okay, his mood and the tone and okay, his outlook, etc., everything. Okay, so the very first thing, okay, it was even before this, the event has happened on 22nd. Okay. So in my pre-market update on 22nd, okay, before the open of the S&P 500 and the entire stock market, okay. So what we knew is that a day before this, the event has happened, the press conference, okay. The stock market, means the S&P 500, okay, it has breached the technicals level 3991, okay, which it was not supposed to, even in the best case scenario, right? And the same was okay until the like 1 hour or 45 minutes, okay, before the closing, and the only reason was the volatility. So that the last 1 hour or the last minute push on 21st of March, it was there because there was the speculation. This speculation was spread, okay, by the market manipulators through all of these platforms, okay, that they own or they indirectly, okay, they control. So they have, this was the speculation that Fed may pause the rate hikes for this month. Okay, because of this speculation, there was this the bullish push. Okay, on because of this speculation, there was a bullish push, and other than that, there was no valid reason, right? The very first thing is that at 2 p.m. This was the first update. At Feds have raised the target range for the federal funds rate from 4.75% to 5%. Okay, this means that the Feds have raised the interest rates by 25 bps. So one day before this the rate hike, there was a speculation through all of these the news platforms and all of these are social media platforms that are owned or indirectly controlled by the market manipulators. Okay, that the Feds may not raise the interest rates. Okay, this was there. But when it was clear at 2 p.m. Eastern Time, US, okay, on 22nd of March, that now the Feds have raised the interest rates by 25 bps, suddenly we have seen an upward movement to 4035 zone. Okay, so we were ready for this, the 4035 zone. So after 25 bps rate hike, okay, it moved up. It was not supposed to move up, okay, after this the 25 bps rate hike. This was an early indication why they are forming a bullish trap, because a 25 rate hike, because a 25 bps rate hike means there will be more stress on the banking sector. The Federal Reserve Chairman, okay, and the committee has observed, okay, this thing, that there will be a stress, okay, on this the banking sector by raising the interest rate. But as of now, they are in a situation where they cannot stop, okay, they cannot pause the rate hikes. So because of this, after the 25 bps rate hike, we have seen this the upward movement. It was clear that it is going to come down. It's a bullish trap, because it was not supposed to move up, rather it was supposed to come down, because there will be a stress, okay, in the banking sector, more stress in the banking sector. Now, so first okay, update that was. Then the second was the projections. The projection shows that the federal funds rate is expected to remain in between 5.1 to 5.6, okay, in 2023, and that it will start declining in 2024, and then in 2025 it is expected to come back to around 3.0. Means in 2 years, it will take 2 years. It will take 2 years, okay, from 5.1 to 3.0. This means that the Federal Reserve, okay, Federal Reserve has raised the interest rates heavily back to back every month, from 2% or around to 5%, okay, in just 1 year. But it will take from 5% to 3%, means it will take 2 years, 2 years to come down from 5% to 3 years. So now you can clearly see that the rate hikes are steep, very heavy, but the rate cuts will be slow. What it means? This is the early sign of the recession, that the rate hikes are steep and the rate cuts will be slow. This was in the projections of the Federal Reserve, okay, directly, okay, means it was directly there, okay, in this the projection of the Federal Reserve. However, it is not about 5.1, it is about 5.6, okay. This month it was 4.88%, okay, Federal Reserve fund rate, okay, it was increased to 4.88%. And because they have considered 5.6, this means that 2 or 3 more rate hikes will be there this year. However, this is not fixed. This number is, or this range is not fixed. It will change. It can change. Earlier, the Federal Reserve, okay, has said that we will go for the 4%, then 4.5%, then 5%, then 5 to 5.1%. So every month or every meeting, they are simply raising, okay, this is the target rate, right? So this means that it is just a projection. Okay, this is just a projection. This is not a fixed thing that no Feds are going to stop the rate hike. And that is why through all of these the news channels, through all of these the news platforms, through all of these okay, these influencers, okay, who are controlled by the market manipulators or directly influenced by the market manipulators, you would have seen on the same day that the Feds are nearing to the end of the rate hike and now is the time to go bullish. No, because everyone was asking you, everyone was saying you to go bullish so that the market manipulators can trap you and then they can make money just like they did. Okay, so this is how they run, because they control the information, they control, okay, everything, and they want you to get the same information through through all of these channels, through all of the platforms at the same time, so that you can think, okay, yes, this is the reliable information, but in actual it is not. Okay, so the projection itself, okay, so this was my second update to my YouTube community members. So my YouTube community members, that okay, they were aware of these things, so they were not trusting, okay, these are news platforms, but they were looking into these updates and they knew what is truly happening, right? Anyways, Feds are still considering future rate hikes that will range from 5.1 to 5.4 by December 2023. This year, this means 25 rate hikes in subsequent meetings 1 or 2 times is expected, and this means now Feds are planning to raise the rates 1 or 2 times by December 2023. However, remember, these are the projections, and Feds have revised the projections in every meeting, right? Then the next rate hike will be in the month of May. So there is no FOMC meeting in the month of April, okay, just for your information. And the next rate hike will be in the month of May 2023. And Feds are also projecting that the inflation will be back to 2% range by 2025. This means that Feds are still not sure. Federal Reserve, okay, these people, they are still not sure, okay, these are policymakers, okay. So they are still not sure that the inflation will come down to 2% within 2 months, 6 months, or 1 year. They are saying that by 2025 the inflation will come back down to 2%. As of now, it is 6%. Okay, then it will come back down to 2% by 2025. Means it will take 2 years. They themselves, the Federal Reserve, they themselves are expecting that it will take 2 years. 2 years from 6% to 2% decline in the inflation. Right. So how can you trust these news platforms or these the market manipulators who are saying that the Feds are nearing to the rate hike? Okay, end of this the rate hike. They will pause the increasing these are rates, and then everything will be okay. It will be back to normal. Whereas the Feds have. So the Fed themselves have confirmed, okay, through their projection. Again, this is not a confirmation. Remember, this is not a confirmation, but this is just a projections, and projections can be and will be revised. Okay, this is the target fund rate from 5.1% to 5.6%. It can be revised to 6%, not a problem. Okay, and if we accept, okay, these are numbers, then it will be 7% before we can actually see the Feds are going to reduce or Feds are going for the rate cuts. Okay, it is the 7%. As of now, Feds are projected 5.6%. But in actual, okay, this the data analysis says, or this the complex numbers, okay, analysis says that it will be somewhere around the 7%. Feds will, so Feds first they will push it to 7%, and then only they can come. Okay, then only they can go for this the rate cut. That is the reason why they are saying that 2 years or more it will take from from here to come back to 3%. That is the reason, and this is something that no one is going to tell you that this is happening, and this is why the Feds were saying that it will take 2 years. Why 2 years? If it means if the Feds took just 1 year to raise the interest rates, okay, by like 4%, 3% or 4%, okay, just 1 year, then why it will take to reduce, okay, or to go for the rate, then why it will take 2 years or more than 2 years just to bring it down by 2%, 3%, right? So the reason is that the technical, okay, the data analysis says that the Feds still, okay, they have enough room to up to 7%. Okay, so 7% or near about 7% is something from where we can expect this the rate cuts, right? So what it means by 7% or 6%? Recession, nothing else. It simply means recession. Okay, now there is a lot of stress in the banking sector. Okay, we have seen the failure of the banks. Okay, first it was the Silicon Valley Bank. Okay, then it was the Signature Bank. Okay, then it was the First Republic Bank. Okay, which is like 50-50 situation. It can come down, okay, anytime. Then there was this Credit Suisse. Then there was this the Credit Suisse, okay, in the Switzerland, one of the most trusted bank in one that has 150 years of history. Okay, that bank has gone down. Okay, now yesterday there was a news about the Deutsche Bank. Okay, so there is a stress. Okay, stress only when the Feds are around 5%. What will happen when they are around 6% or 7%? A confirmed recession, not a recession, but a great recession, right? So this is something I mentioned up many times earlier. Anyways, So the current data indicates that the Feds are nearing to the limits. However, we must not forget that the above mentioned rates are projected, once again projected, and the projection and can be altered if needed, as the Fed earlier set a target to 4%, which then they revised to 4.5%, and now they have revised it to or raised it to 5%. Thus, a further possibility is still there if the situation goes out of control. When I say the situation, I mean the inflation. Okay, Feds are not after the banks or the banking system. No, they want to stabilize everything, but the problem is the inflation. That the inflation is not coming out of the inflation is not coming under control. Okay, recently we have seen the 6% inflation. Okay, back to back 3-4 months. Okay, it is coming down. And if you think that it is coming down, no, that is okay. This is not true. This is not true, because be ready to see a bullish reversal in the inflation anytime. Okay, because be ready to see a bullish reversal in the inflation, okay, very soon. And Feds are aware of this fact that the inflation will give a bullish reversal. Okay, as so means this is the month of March, then April, May, June. Okay, means when the summer season will come. Okay, then we will see some food shortage. Okay, some supply. Okay, then the fire, droughts. Okay, floods, etc. So that will simply impact the supply. Okay, this is the food chain. Okay, means the food production actually, and that will again is expected to give a bullish reversal to the inflation, right? Feds are aware of that fact, and that is the reason they are not prematurely going to pause the rate hikes or to go for the rate cuts. So guys, just bear with me, because it will take like 10 more minutes, I guess 10-15 more minutes to decode the entire picture, because this is a big term picture. Okay, because this is a long-term picture, and this will tell you that what you should trust and what you should not, right? So the third update, it was the federal fund rate for the year 2023 is 4.9% to 5.9%. Okay, and for your information, currently it is 4.88. From 4.88 to 5.9, what it means? This means that still there is enough room for 4 more rate hikes in the year 2023. So from earlier 1 to 2 rate hikes, now it was 4. There is enough room to raise 4 times interest rates in the year 2023. Okay. Then in the December 2023 projections, are from 4.9 to 5.6, and again it is 4.88. This means enough room for 2 to 3 rate hikes. So in simple words, from here and here, the funds rate and this is the projection, target rate. It is clear that this means there is enough room for more rate hikes and not just one, which you might be hearing through the news channels, articles, or platforms. So now comes the fourth update, where upon his opening comments, to his the press conference. At that time the tone is either neutral or hawkish or concerning, but definitely not dovish. Definitely not dovish. Everywhere you will read that it was dovish. No, it was not dovish. It was either neutral or hawkish or anything. It can be anything, or it was anything, but it was not dovish. This was the opening comments. Then the ongoing rate increases are replaced with something to be determined considering current situation. And this was again the reason why we have seen this spike. Why we have seen this spike, here. This, because the ongoing rate increases are replaced with to be determined considering current situation. This was the spike because of that. Anyways, then comes the next update. Ongoing hikes to some rate hikes. Further rate hikes will be based on the assessment of the upcoming data. He is more concerned that more rate hikes may break the financial system, but if necessary, then the rate hikes will be there. So it moved up, then it came down. It came down because because he has mentioned that some rate hikes, based on the assessment of the upcoming data. Now, from his previous comments, to be determined considering current situation, to based on the assessment of the upcoming data. Means he said that if the data comes like bad, means the inflation, if it goes bullish, if it moves up, then yes, definitely the rate hikes will be there. And then again, this the fund rate, it will be revised. Okay, so like in almost in every meeting, okay, Feds are revising this the fund rate. Okay, so they Feds have said, okay, this the upcoming based on the upcoming data. He was more concerned that the more rate hikes may break the financial system, but if necessary, then the rate hikes will be there. Now, in my seventh update, okay, now he has mentioned no rate cuts this year 2023. What the news platforms were telling you that there will be just one more rate hike, okay, and there was a heavy speculation that the Feds may stop or may pause, okay, these are rate hikes. But now he has cleared that no rate cuts in the year 2023. When, okay, one of the reporters has asked him that will there be any rate cuts, he has cleared no. Okay, he has clearly said that no, there will not be any rate cuts in the year 2023, and that immediately dropped. Okay. Anyway, so the rate hikes are doing the same thing that are there from the banks. Tighter credit conditions means failure of the banks or the bank run. Okay, so this is the same thing. Rate hikes are doing or creating the same impact that is the banks. This means that when Feds are not raising the interest rates, then the banking system, okay, it is in the stress, and the banking system, there are these bank runs creating mayhem, okay, and this thing. So they are doing, okay, the same thing that the rate hikes are doing. Okay. This means that no matter what, whether it's a rate hikes or this the stress in the banking system, okay, both are bearish. Both are giving bearish outlook to the entire stock market. Okay. Then comes the eighth update. Now, at that time, it was clear that the stock market has celebrated on the account that the Feds will pause the rate hikes and will start doing rate cuts in 2023 year itself. But that's not the case, and that's not true. Rather, the thing is that the Feds are doing it either through the rate hikes or through the bank run, indicating if the rate hikes won't be there, then the bank run will fill that particular space, okay, the space of the rate hikes. And chances are that we can see some more failure in the financial system or some failure in the financial market, okay, means more bank runs. Just like yesterday, okay, it was the Deutsche Bank. Okay, now the Deutsche Bank, after the Credit Suisse, okay, one of the best trusted, okay, or this is 150 years of history, okay, that the bank had, okay. So that bank has seen this stress bought, okay, it was bought by the UBS. Now comes the Deutsche Bank. So it is just the beginning. It is just the beginning. If you are thinking that no, these are just 1 to 2 or 3 or 4 banks, no, it is just the beginning. Okay, the market manipulators through their news platforms or the news channel, they don't want you to know this the big picture, because if you understand the big picture, then you will not be trapped, then you cannot be trapped. Okay, but the market manipulators, they want you to go against the trend, go against everything, so that they can trap. Okay, their sole purpose is to collect the volume, is to get the volume. When the volume is there, billions of dollars, hundreds of billions of dollars, okay, then they will be in a comfortable position to sell heavily, okay, and then they will make a lot of money. Okay, anyways, his voice means the Federal Reserve Chairman. His voice is totally concerning today. Okay, means on that 22nd, rather than hawkish or dovish. Looks like he wanted to do something, but because of bank run, recent issues has brought him a step back. Okay, just now he has confirmed that there is no chance of saying that the Feds are going to stop the rate hikes. Feds will raise the interest rates, and if the data demands, then more rate hikes will be there. This means that terminal rate, okay, this means that the federal fund rate from 5.1 to 5.6, okay, it can further be increased to 6% or 6.5 and 7% I have recently mentioned, right? So he himself has confirmed this, the same thing. Now, finally, in my ninth update, it was clear 25 BPS rate hike and a negative or concerning outlook with more uncertainty and a downward movement. So when I posted this, the update, okay, 25 BPS rate hike and a negative concerning outlook, that time the SP 500, okay, it was around 4015, okay, and then you can see that from 4015 to a heavy fall intraday on the same day. Then in the 10th update, he just said that we don't know whether the recession will happen or not, and this has changed from his earlier comments where he used to say recession is not happening or out of the picture. This was the very first time he has admitted, he has accepted that yes, now the recession may be there. Okay, now because he has accepted the fact that the recession may be there, this means that he understands the situation and he's saying that yes, Now the recession not maybe there, recession will be there, because now there is a stress, okay, on the banking system in the financial market. And other than that, the rate hikes, okay, are necessary, okay, because the inflation is not coming under control. The European Central Bank chief has said that the inflation is out of the control, and it will remain out of the control for some more time. Okay, so now at least now this is clear that the recession will be there officially. Okay. So in my 11th update, okay, it was, I have never seen him so tense or concerning in last many months, okay, and this is the first time. He looks very tense and concerned and looks like something is not right. Something is not right, and he's not ready for the things happening or have happened or are going to happen, right? This time he said indirectly recession can happen, right? Uh, Anyways, guys, then my final update to my YouTube community members before the closing of the stock market on that particular day. Okay. So press conference, it was very clear that he was concerned. Okay, inflation. He is much concerned about the recent event that has happened, which says that the inflation is still high, labor market conditions are very tight, people are getting the jobs, more jobs available than the people themselves, right? Supporting bullish inflation, and now comes the bank run. Okay, means a perfect cocktail for the inflation. Sorry, a perfect cocktail for the recession. Okay, not just the recession but for the Great Recession. Okay, everything has now like almost okay came to, so everything just came at the same time, okay, or at the right time. Everything like banks, inflation, labor market, everything. Okay, then he has confirmed that the appropriate rate hikes will be there. However, the rate hikes are giving the same effect as the bank run for the instability in the financial sector. And today is the first time, okay, means on that particular day, okay, it was the first time he has indirectly admitted that the recession can happen. And as you might be aware of the facts that earlier he has denied that the recession is not happening or may not happen. Okay, inflation, labor market, bank run, instability is a perfect recession cocktail. Then he has confirmed that there will be no rate cuts or pause in the year 2023. But the best part, surprisingly, okay, this is the amazing thing that we knew, okay, this is what he has said. And not just we, but everyone, okay, whosoever follows the stock market, okay, the technicals, the data analysis, okay, and the Fed chairman, okay, comments, decode the comments of the Fed chairman, okay, we people know that, yes, this is the picture. But even after everything was there, I have not seen any of these the news channels or the news platforms saying, okay, these exact same things. No one did. But the only thing that I've seen on these the news platforms, okay, or these everywhere, was that the Feds are nearing to the the rate hike, okay, end of the rate hike, and just one more rate hike. That's it. Means they were giving these the bullish sentiments. Okay, everyone was giving these the bullish sentiments, and no one was talking about these things. Okay, but this is what was the true picture. This was the true picture. Okay, so now again, this is so now. So this was done intentionally, okay, because the market manipulators, okay, they wanted you to go bullish. They wanted to trap you so that they can accumulate the volume and then they can sell. Okay, so the same thing we have seen. Okay, this day heavy fall, this day upward movement, then a fall, then okay, this thing again looks bullish, but it's bearish. And for those who wanted to know whether the tone was hawkish or dovish, so I can say that it can be considered anything, but it was clearly not dovish. It was not dovish. So now, guys, I hope that this picture is clear, that the Federal Reserve, chairman and the FOMC, members, committee members, they are concerned, okay, on this inflation part, and they are saying that there's the target fund rate, okay, that they have revised. This is the projection. It can further be revised, okay, to 6% or to 6.5%. But yes, 7% is at most that we are anticipating. That once it comes around to 7%, okay, 7%, that will be the time when we can anticipate, okay, rate cuts. And then from 7% to 3%, it will take 2 years or more than 2 years, okay, for these rate cuts. But around 2 to 3 years, you can say, because when there will be the recession or the Great Recession, okay, everything will slow down, everything will come down. In that case, the Feds will be required, or the Feds will be asked to give the support to the economy, and then they will start doing the rate cuts so that the stock market can move up. and so that the loans can become cheaper, and so that the people, okay, they can go for the loans, they can borrow the money from the banks or the financial institutions, and the businesses, okay, and whatever they want to do, they can. As of now, the interest rates will, okay, increase, and if you are planning to to get the loan from the banks, then that is again further going to increase. The loans will be costlier, okay, and not costlier but more costlier, okay. So until and unless, okay, it comes around like 6 to 7% in this particular range, okay, there is no confirmation that the Feds are going to do any kind of rate, like pause in the rate hikes or the rate cuts, okay. That is not there, okay. For now we need to wait for the inflation, because even though for 4 continuous months inflation is coming down, but the Feds themselves, okay, they are not accepting this the downward trend in the inflation. They know that anytime the inflation can give a heavy bullish reversal. So guys, once again, if you have not subscribed to my YouTube channel, then please subscribe to my YouTube channel and click on the bell notification icon. And if you are looking for these daily updates, the daily analysis of the S&P 500 from Monday through Friday, each and everything, and not just the updates, but the stock market opportunities, 5 to 10 opportunities every week, then you can join my YouTube community. I have given the link in the description of the video and also in the comment section. Now guys, let's move on to the third point of the agenda of this S&P 500 weekly technical analysis. And the third point of the agenda is the support and resistance levels for the S&P 500 for the coming week. That is for the week of March 27th, 2023. That is from March 27th, Monday to March 31st, Friday. Now guys, we are here, and this is the third point of the agenda of this S&P 500 weekly technical analysis. And the third point is the support and resistance levels for the S&P 500, okay, in the coming week. So guys, as of now, the very first thing that you must understand is this is the Ichimoku cloud, okay. Now if you notice that there are three closings back to back, three closings below the Ichimoku cloud, okay. What is this? The below the Ichimoku cloud? Bearish, okay. This is all bearish, okay. Three closings generally, okay, we accept this the two closings, okay, two consecutive closings, okay, that is enough to confirm. But now we have the three closings below the Ichimoku cloud. This means there are more bearish sentiments as compared to the bullish sentiments. Recently, in the first point of the agenda of this S&P 500 weekly technical analysis, we have seen that on the weekly chart it is bearish. The trend is bearish, okay, no change in the trend. The trend is bearish. Okay, now further the same is we can say, okay, something means this is what we can see here, three consecutive closings below this the Ichimoku cloud, okay. Now this means that, and secondly, okay, there is like this the banks, okay, problem, stress in the banking sector, inflation, labor market, and the Fed chairman himself, okay, confirming that more rate hikes, okay, and the revision of, okay, this the projections, okay, will be there, okay, if needed, okay, if the data demands, if the inflation demands, okay, then it will be there. This means as of now there is nothing, okay, that we can call as bullish, okay, neither through the technicals, okay, nor through any of the XYZ factor. What it means? This simply means that now any bullish movement, it should be limited. I am not denying, or I am not saying that there cannot be any bullish movement. I am simply saying that any bullish movement should be limited. Okay, limited to what? Limited to at first the boundary of the Ichimoku itself. Okay, and that is what? That is 3980. This is 3980, and this will be the immediate resistance or the immediate heavy resistance for the S&P 500, right? Now, what is beyond 3980? Beyond 3980, we have 3991. Okay, earlier many times it has acted as a very strong support as well as resistance, okay, but recent times, okay, we have seen a breach of this resistance level. That is why, okay, we are saying, okay, that 3991, it is a heavy resistance indeed, okay. It will remain heavy resistance no matter what, okay, even though there were recent breaches, that doesn't matter. It is a resistance, it was heavy resistance, and it will remain the heavy resistance. This means that in case of the heavy resistance of 3991, okay, then we can accept the fact, or that we can accept any movement up to 4007. Okay, now guys, one more thing that you must remember. Anything anything which is like 0.5% bullish, 0.4% bullish can be accepted, not a problem. Anything like 1%, 2% bullish, okay, it is clearly a trap. Okay, last time also when it was moving around here, I mentioned this thing that above 4035, above the zone of 4035, it is pure manipulation, pure 100%, 200% pure manipulation, nothing else. Means heavy instability, and anytime you will see that the S&P 500, okay, it can come down. Whenever it comes down, it will come down very heavily, because anything beyond 4035 zone, okay, at that time it was not supported, okay, through and means neither through the technicals, not through any of these the news or whatever, okay, but still, okay, the market manipulators, okay, they try to move it up, they pushed it to 4078, and then we have seen a heavy fall. Okay, so again I'm saying that now in this case what I can say, or what we can see, is that anything beyond 3991, okay, or if we consider this the 200 day EMA, then, or in simple words, anything beyond 4000, anything beyond 4000 is pure 100%, 200% manipulation. As soon as it moves up, okay, see, it will become unstable as soon as it goes above 3980, okay, but if it goes beyond 4000, okay, it will be very heavily unstable. And whatever we have seen earlier, okay, a beautiful trap, it was a beautiful trap, okay, and I've informed you very well in advance that it is a very, very beautiful trap. Okay, similarly a beautiful trap will be here, and then a fall. Okay, this means that the trend is bearish, means any bullish retrace is an opportunity to go bearish. Simple. Okay, this means that as of now, not 4007 but 4000 itself, okay, 3991 or 4200 EMA, okay, just intraday, okay, if intraday, okay, if we have to consider a count, then 4007, okay, and also I have considered the 4035, okay, this is in the best possible manipulated scenario, okay, 4035, otherwise it is not there in the picture, or anything beyond 3991 or 3998, okay, as such it is not there in the picture. Okay, and guys, once again I have seen many people complaining that if I say 3991, okay, and it moved up to like 3995, okay, this means that my resistance levels, okay, have failed, or it moved up to 3998. No, my resistance levels have not failed. It moved up intraday, okay, just a bit up down, it moved up to 3995, and then immediately it came down heavily. Okay, so resistance levels worked as they were supposed to. They are working as they were supposed to. Okay, or as they are supposed to, right? So see, a breach of 2 points, 3 points, 5 points, 7 points, okay, this is normal, and you should be ready for that. So I have never said this thing that if I'm saying 3991, then dot 3991 it will be there. Yes, sometimes it happens, okay, and many a times historically it has happened, okay, on many of these the levels. But this is not like that it will work every time the dot level. 2 points, 4 points, 5, 10 points, okay, plus minus, it can happen. Okay, see, and one more thing, that I do not control the stock market. Okay, I'm just a technical analyst. Okay, I'm not a market mover, or I'm not a market manipulator. Okay, which is why I cannot say that exactly, okay, every time it will hit the dot. Okay, so you should be ready for 2 points, 4, 5, okay, 7, 8 points. It's etc. Okay, this can happen, but eventually what will happen, the technicals, these are support and resistance levels, will work as they are supposed to, and they will give the desired results. This is clear. Okay, anyways, then 3991 we have, okay, now comes the support. Immediate support is at 3960 or 3965. Then we have 3937. The zone of 3937 has given very good support to the entire to this the S&P 500, okay, many a times. 3937. This means a breach of 3937, a close below the zone of 3937 is mandatory in order to see a downward movement. Downward movement to what? Downward movement to 3840 to 3790. Okay, this means this is necessary, this is compulsory, this is mandatory. Okay, so 3937 is a very strong support. Then we have 3907. Okay, again a very good support. Then 3884, intermediate support. But the best support, the question that we have talked about, okay, many a times, it is from 38 3840 to 3790. This is the strong question because the S&P 500 earlier has find very good support. Okay, or this is the question. This means that whenever it comes down this time, at least for one day, okay, it will find very good support. Okay, on this the question. Now comes this the second part. The second part is that now a breach of this zone is possible. Earlier it was not possible. Okay, I've clearly mentioned that it cannot happen. A breach is not possible. Rather, a reversal will be there, and a reversal was there. Okay, this time for one day, yes, we can accept that. Yes, that this particular strong support or this cushion can hold the S&P 500, the downward movement of the S&P 500. Okay, but this time a breach is possible. It is okay. It is means it is highly likely. It can happen. It is permitted. It is allowed to happen. A breach of this particular cushion, this particular strong support. When the breach happens, then it will come down to 3765, then 3735. But the strong support zone, that next support zone comes from 3710 to 3695. Okay, this is the strong support zone. Okay, then comes 3660, 3630, 3585. Yes, 3585 will be the next strong support zone. So in the coming week, okay, we can accept that we can expect that a fall to 3840 to 3790 is possible, fairly possible. Okay, then it will be a little hard for the S&P 500 to come to 3710 to 3695, but it is still there. Okay, but yes, a breach of this particular level and coming to 3585, okay, it can happen only if there comes a very heavy fall, very heavy fall. Otherwise 3710 to 3695 will be able to hold this the downward movement. Okay, so in short, we can say that in the coming week, okay, the movement of the S&P 500, it will be confined, okay, around in a round figure to from 4,000 to 3790 or 3,800, okay, 200 points this year, and then from here to 3710 to 3695. Okay, this is fairly possible. So now, guys, there is one more important thing that I want to share with you. And this is regarding my YouTube community, like how you can join my YouTube community in order to get the daily updates, the daily analysis of the S&P 500 from Monday through Friday, each and everything. And not just the S&P 500 updates and analysis, but also the stock market opportunities. Okay, 5 to 10 minimum 5 to 10 opportunities every week. So in order to join my YouTube community, you can visit my channel page. I have given the link in the description of the video and also in the comment section. And on this YouTube channel page, you will see this the join button, JOIN join button. And other than that, you can also access the join button directly. That is there just below the title of this video, the join button. So once you click on this, the join button, then this pop-up will open. Now in this pop-up, you will see that there are these the two updates. One is the daily S&P 500 updates and the other one is the updates and opportunities. So the daily S&P 500 updates means that you will get the daily S&P 500 updates, daily analysis from Monday through Friday, everything, pre-market update, first, second, third, fourth, fifth, sixth update, then the final update, everything from Monday through Friday. Okay. Then comes the updates and opportunities. So the updates and opportunities will give you the daily S&P 500 updates from Monday through Friday as usual, updates and the analysis, as well as all of these the opportunities, the stock market opportunities, 5 to 10 opportunities minimum 5 to 10 opportunities every week. And if you notice that many people have opted for the daily S&P 500 updates and analysis and the updates and opportunities for last many months, and they are getting the daily S&P 500 updates from Monday through Friday and 5 to 10 opportunities every week. So guys, whenever you want to join my YouTube community, so you can opt for either for the daily S&P 500 updates or the updates and opportunities. Now guys, there is one more important thing, that once you have joined my YouTube community, then you need to visit my YouTube channel page. Okay, the same link that is there in the description. And then you need to use this, the community tab. So all of the updates will be there in the community tab of my YouTube channel. And if you are using the YouTube app on your mobile phone, then you will be getting the notifications through the YouTube app. So guys, once again, I have given the link in the description of the video and also in the comment section. And other than that, you can simply use this, the join button, JOIN join button, that is there just below the title of this video. Now guys, we are here and this is the fourth point of the agenda of this S&P 500 weekly technical analysis. And this the fourth point of the agenda is the S&P 500 technical analysis on the daily chart. Let me write it down. Daily chart, D as in daily chart. So daily chart means that one candle represents one day, not 1 hour or 1 week, but one candle means one day. Okay. So we have seen on the weekly chart that the trend was bearish, 90% bearish. Okay, just near to the absolute bearish, but it is 90% bearish. Trend is clear, bearish trend. The big picture. Okay, big picture. Now let's see what is happening. Okay, in this the short term. So in the short term, first comes the candle. If you look into the candle, then the closing of the candle is almost around the high of the candle. What it indicates? This indicates that at the time of closing, there were some bullish sentiments. Again, some bullish sentiments at the time of closing. What it means? This means that on Monday, okay, initially upon open or around open, okay, just after open, initially we can expect some bullish movement. Some, again, I'm using the word some, okay, not heavy or not something, but some, S-O-M-E, some, okay, some bullish movement. Okay, or if there comes a downward, or if there comes a gap down open, okay, and if there is not heavy selling, in that case, after the gap down open or after there's a downward movement, little bit downward movement, okay, we can say that yes, intraday we can expect, okay, a little bit retrace. Okay, so this bullish candle is simply representing some bullish sentiments, okay, that can give initial bullish support on Monday. Okay, not for the entire week, but only on Monday, and on Monday also the initial support. That's it, nothing else. So the technical indicators, this is the upper band of the Bollinger Band, and this is the median of the Bollinger Band. Yes, okay, this is the change. This is the median of the Bollinger Band. Okay, because the S&P 500 was able to close in between the upper band and the median of the Bollinger Band. This means that through the Bollinger Bands, S&P 500 is bullish on the daily chart. Okay, now comes the moving averages. Clear fan out in the moving averages, and the S&P 500 has closed above these the moving averages. This means that the S&P 500 is neutral through the moving averages or the EMA, okay, on the daily chart. Now comes the Ichimoku cloud. Because the S&P 500 is clearly, okay, it has closed below the Ichimoku cloud. This means that the S&P 500 is bearish through the Ichimoku cloud. Okay, so there is some up, down or neutral, etc. So the picture is not clear here. Okay, but now surprisingly something has happened here. Okay, and that surprising thing was this the MACD. Okay, so MACD, okay, it was earlier, it was bullish, it was holding bullish, and it is still holding bullish. It was supposed to come down. When it was coming down, that time, okay, it was very near to not okay, yesterday also and also on Thursday, okay, it was giving a bearish crossover. See, a crossover in the MACD and the signal on the daily chart, okay, it can happen like in 2 to 3 days, 3 to 4 days, okay, but a crossover in the MACD and the signal on the weekly chart, it will take 3 to 4 weeks, means 1 month. Okay, this is the difference, because there are the weekly candles, and here, okay, we are dealing with these the daily candles. So through the daily movement, okay, we can expect that if there comes a crossover, or if there has to be a crossover, then that crossover, okay, either side can happen, okay, in as early as 3 to 4 or 4 to 5 candles. That's it. Okay, now the best thing that has happened here, so through the MACD, because MACD is more than the signal bullish, however, both MACD and the signal both are negative. This means that the long-term bearish trend. Okay, but directionally it is bullish through MACD. Now comes the best part here. This is the stochastic RSI. The change in the stochastic RSI, yes, the K channel is less than the D channel. This means that S&P 500 is bearish through the stochastic RSI. Okay, this is bearish, and as such you might think that okay, that it is not going to make any heavy impact, but yes, there is a very heavy impact. Okay, the impact is that now the MACD is bullish, stochastic RSI is bearish, both are opposing each other. That is the significant part. both are not aligned in the same direction, but both are opposing each other. What it means? This means that whatever is happening in this bigger picture, that will be applicable here, and this is simply nullifying the effect. And this is, you can simply say that the MACD and the stochastic RSI both are giving a neutral signal to the S&P 500. Okay, because MACD is going bullish, stochastic RSI is bearish, so it is means as of now it is simply putting the S&P 500 in a condition. Generally, okay, we have seen a consolidation. Okay, but it is too early to confirm a consolidation. We need 2 or 3 more candles to confirm the consolidation. And if you are my YouTube community member, then I guess by Wednesday, Tuesday or Wednesday, it will be clear whether it is heading into the consolidation or not. See, now the S&P 500 has, or the entire stock market has only 2 choices. Either it will move into, or either it will go bearish, heavily bearish, okay, or if it doesn't want to, if it want to hold, then it can enter into the consolidation. These are the only 2 choices. Bullish is out of the picture. Anything beyond 4,000, okay, or the 4,007 is purely 100%, 200% manipulated movement and a bullish trap, a beautiful trap. And that beautiful trap will convert into an actual trend only and only if the S&P 500 is able to trade above 4075 or 4076. There comes a crossover in the moving averages. Then all of the technicals are aligned bullish. So for now, technically, okay, that is not seen. For now, technically, that is not seen. That is why I am saying that it is, or it will be a bullish trap, right? Anyways, we will cover this part in the last 5th point of the agenda of this S&P 500 weekly technical analysis. Okay, that will be the probable movement of the S&P 500. Okay, so anyways, and all other technical indicators are normal. Volatility, it moved up. Okay, it was very high. Okay, and it is holding. Okay, the volatility is holding. So what it indicates? So what these are technical indicators are indicating? 2 bearish, 2 bullish, 1 neutral. This clearly means that on the daily chart, S&P 500 is neutral. Simple. Okay. Now, what it indicates? What it indicates the neutral. What it means by neutral? Neutral means that whatever is happening on the weekly chart will be applicable to, okay, the S&P 500 weekly chart. It is 90% bearish, long-term bearish trend. Means the S&P 500 will follow its the long-term bearish trend. Okay. Any bullish reversal is an opportunity to go bearish. And anything beyond 4,007, okay, it will be considered as a bullish trap, a beautiful bullish trap, okay. And as soon as it moves above, or it trades above 4,000 or 4,007, it will become unstable, heavily unstable, okay, just like what we have seen here, okay. Similarly, the same thing, okay. Anyways, so guys, once again, if you have not subscribed to my YouTube channel, then please subscribe to my YouTube channel and click on the bell notification icon. And if you want to join my YouTube community through YouTube membership, then you can. Then I've given the link in the description of the video and also in the comment section. You can use those links in order to join my YouTube community. Now, guys, let's move on to the 5th and the last point of the agenda of this S&P 500 weekly technical analysis. That the last point is the probable movement of the S&P 500 for the week of March 27th, 2023. That is from March 27th, Monday to March 31st, Friday. Guys, now comes the 5th and the last point of the agenda of this S&P 500 weekly technical analysis. And here we will talk about the probable movement of the S&P 500 from Monday to Friday. So everything that I'm going to tell you here, okay, will be applicable to the S&P 500 until March 31st, Friday. So guys, a few things that you must know and that you must understand, okay, for the previous, for the next week, for the coming week, okay, that is for the week of March 27, 2023, okay. The first thing is that on Friday, on March 31st, okay, the PCE and the core PCE data will be published, okay. So this, the PCE and the core PCE data, okay, this is one of the important data that the Feds, okay, they consider, okay. And when we look into the projection, that what the Wall Street is, not projection, but the expectations, that what the Wall Street is expecting. So the Wall Street is expecting the same as the previous month. So previous month, it was 0.6%. Okay, this month they are also expecting the same 0.6%. Okay, so now you can see that the Wall Street is also expecting the same thing. Okay, and I think this is the core. No, this is the core PC. The PC. Okay, they are expecting a decline from 0.6% to 0.4%. Okay, so even the Wall Street is not expecting any heavy decline. Okay, in this the PC and the core PC. Okay, so the big players, okay, these are market movers, they are very well aware of this the situation. Okay, and whatever you are seeing here, okay, in terms of this the movement of the S&P 500 or the movement of the stock market, okay, this is just against what we know, okay, or what the Wall Street know, okay, or the what the Wall Street is anticipating, right? That is, and other than that, okay, we have some other, this is the data that will be coming, okay, almost every other day, starting Tuesday. Okay. Now, the one more thing that you must understand here, it is the Dow Jones. Okay. Now, in the Dow Jones, on the daily chart of the Dow Jones, okay, this is bearish through the moving averages, bearish through the Bollinger Band, bearish through the Ichimoku cloud, bearish through the stochastic RSI. Stochastic RSI is bearish and MACD is bullish. Okay, they are simply just opposite to each other. Clearly bearish. Dow Jones is clearly bearish on the daily chart. What we have seen on the daily chart of S&P 500, we have seen on the daily chart of S&P 500 that it is neutral, right? But on the Dow Jones chart, it is clear that it is bearish. Okay, through these are technicals, right? And other than that, if you look into the futures of the Dow, so the Dow futures, okay, by the time of the closing, okay, the Dow futures are clearly once again bearish. Okay, Dow means the Dow Jones. The Dow Jones Index is clearly bearish, and because the Dow Jones is okay, most of the times, okay, Dow Jones is on the driving seat. Okay, this means that because the Dow Jones is bearish, Dow futures are bearish, the same bearishness is expected or is in line with the bearishness that is there on the weekly chart of the S&P 500. Okay, and the same will be expected there. Okay, in the entire stock market. Now, why the S&P 500 is moving up? Okay, see, as we know that the Nasdaq, when we talk about the Nasdaq, okay, Nasdaq and its ETF, and the ETF of the Nasdaq is QQQ. Okay, this is the ETF of the Nasdaq. So the Nasdaq is okay, we call it as a tech index. Okay, because like Apple, Amazon, okay, and Google, okay, Microsoft, okay, they actually give the movement to the Nasdaq. So recent times, okay, we have seen this the heavy movement in the Nasdaq and the S&P 500 because the S&P 500, when we look into the S&P 500 and its constituents, then we have Apple, we have Microsoft, Google, Amazon, okay, Tesla. Okay, but and these are the major contributors to the S&P 500. Other than that, we have many other non-tech companies also in the S&P 500, which is why the movement in the S&P 500 is less than the movement in the Nasdaq. So Nasdaq, you will see that noticeably, okay, it is heavily bullish. Okay, most of the time it is heavily bullish. It is bullish because when the market manipulators they give the movement, then generally, okay, they either go for the Apple or the Google. Okay, sometimes they go for the Microsoft also. Okay, and a few times, okay, Amazon. So they know that by manipulating, okay, these are big stocks. Okay, they can manipulate these are two indices, S&P 500 and the Nasdaq. Okay, and when they manipulate the Nasdaq, then they simply indirectly they manipulate the ETF of the Nasdaq, that is QQQ, right? Anyways, now because the Dow Jones is bearish, okay, so that is a point of relief to the bears, and that is why I mentioned that even though, okay, this is a bullish candle, this is indicating some bullish sentiments that will be applicable only on Monday and also on Monday only in the initial hour. In the initial hour, like in 5 minutes, 15 minutes, 1 hour. Okay, that's it. Okay, nothing else. So this thing, okay, that you must be, and again, okay, I have clearly and I have very clearly mentioned, and I've cleared your doubts, okay, and everything. We have simply decoded. We have decoded the comments of the Federal Reserve Chairman, that what he has actually said and what he means and what is going to happen, what is expected to happen. And there's no need to fall into the traps of the market manipulators. Okay, they can give you a little profit like 0.5%, 1%, but eventually, okay, they will simply cover, okay, everything by, okay, giving a heavy fall, like a heavy bearish candle, and all of your 0.5%, 1% profit, okay, they will be like gone. Okay. Anyways, now the probable movement. First of all, as of now, okay, if I talk about like through these are technicals, okay, then on Monday there is some possibility that we can expect a flat open, okay, a flat open or irrespective of open, okay, initially some bullish movement, some bullish sentiments, okay. Now this bullish movement will be to what level? It will be to the 3980. Okay, that is the boundary of the Ichimoku itself. Okay, see, boundaries of the Ichimoku, whether it's the bearish boundary or the bullish boundary, okay, they themselves act as the support and resistance levels. That's it. Okay, for now the boundary of the Ichimoku will change only after 14th April, only on 17th April. Okay, it will change. Otherwise, until then, it will remain 3989. Sorry, 3980. Okay. So any upward movement at first will be limited to 3980. Okay, if it breaches, then 3991. Okay, then just after 3991, then 3997 or 3998. Okay, and at most to 4007. Okay, as soon as it moves up, or as soon as it moves beyond 3980, it will become unstable. Okay, when it reaches 3991, more unstable. Okay, beyond 200-day EMA, further unstable. Okay, so means in this the bullish side, okay, as soon as it try to move up, the more it moves up, the more it becomes unstable, and beyond 4000 or 4007, it is purely 100% manipulated and heavily unstable. Okay, means this movement cannot be relied. Okay, you cannot rely on this movement, and anytime, any day, anytime you will see heavy fall. Now in the bearish side, okay, when you look into this, the bearish side. Now in this, the bearish side, you will notice that the good support, okay, it is here 3937. Okay, this is the good support. Okay, whenever the S&P 500 comes down, it will find support here. Okay, a breach is normal. Breach is not an breach is not a problem, because see, the trend is bearish. Okay, so breach is possible. Okay, fairly possible. Okay, but we are looking for the closing. As soon as it closes below the zone of 3937, then it will clear. This is the zone, and once the zone is clear, then it will come down to 3907, then 3884, and then finally 3840. Okay, it will be actually the 3840 where we can accept, okay, that yes, there will be some hold. Not exactly 3840, but a zone that is from 3840 to 3790. This is the zone, 3840 to 3790. This zone. Okay, a strong cushion. So it might take 1 or 2 or 3 days to come down slowly. Okay, or if there comes a heavy movement, then within a day or two, okay, it can cover, okay, this part. So whenever it comes down for the first day, okay, it will be able to hold. For the first day, it will be able to hold. Okay, second day it can try to show that yes, it is holding. Okay, but this time on the second or the third day, it will be able to breach. Okay, now when it breaches, then there will be further fall. But whenever whenever it comes down, then there will be 3710. Yes, 3710, 3735. From here, it will again reverse back to this the zone of 3840 or 3790. Again a reversal. Okay, it will simply go to retest. Okay, and then only it will further come down. Okay, so like this kind of movement, down, hold, up, down, again reversal, and then a down. Okay, so this kind of movement, okay, we can expect. So this will be as per the technicals, as per the bearish guidance through the from the Federal Reserve Chairman, okay, and through all of this the banking crisis. Okay, this is what should be happen. Okay, or what should happen. Okay, now other than that, I'm also not denying of what I'm not denying, okay, of something like this. Okay, means back to back heavy fall. Yes, it can be there. Okay, but for this to happen, okay, what must be there? That there must come, okay, one more, okay, like a technical, okay, at least one technical condition, an absolute bearish technical condition, okay, that we have seen sometimes here. Okay, okay, or 4-5 technical conditions, okay, or be something like, okay, this is a technical condition, then only we can expect a very heavy fall. Okay, and there is one more thing, okay, very important thing. if there comes a situation where the open of the candle, whether on Monday or on Tuesday, if the open of the candle is equal to high of the candle, okay, that will be the first and the early indication that now the entire stock market want to go bearish, and now you can expect back to back, okay, red candles. Okay, chances of seeing bullish candles will be less, okay, but there will be back to back red candles. Now whether the red candles will be heavy, okay, or normal, okay, that will actually depend on the intraday, okay, these technicals on the lower level charts. Okay, and one more thing, that when I say back to back red candles, that does not mean that intraday, okay, it cannot reverse. So for example, this was the open, it came down heavily, then there was a reversal was up to here, then again it came down. Okay, so so you cannot say that if there will be a red candle, then it will fall and then it will remain there. Okay, it can happen, but an intraday bullish reversal, okay, it can also happen. Or you can say that there was an intraday bullish reversal, it has breached the open, moved up, and then again, okay, it came down, again a red candle. Okay, so this simply means that okay, intraday bullish reversals can be seen. Okay, but because the trend is bearish, that is why technically it is advised that use any bullish retrace to the resistance levels to go bearish. Okay, participating in the bullish trend, okay, it will be risky. Okay, so for example, you can make like 0.5% profits, 1% profit. Okay, but whenever, because we know that the trend is bearish, so anytime, any day there can come, okay, a very heavy fall. So you have made like 0.5% profit, 1% profit, then there will be 3% loss, right? So this is the profit and loss. Okay, so the trend is bearish, so it is always advisable to go with that trend. Okay, and use any bullish retrace as an opportunity to go bearish. Okay, and also convert trap into opportunity. Learn to convert trap into opportunity. Trap will be what? Trap will be this, trap will be this, trap will be this. Okay, convert trap into opportunity. And how you can convert trap into opportunity? Just go bearish whenever it goes bullish, okay, on a bullish retrace. And if you say, or and if you think that I'm just speculating, then you need to rewatch this, the S&P 500 technical analysis. Whatever I am saying is based in purely 100% based on the technicals. Okay, and even if I forget the comments of the Federal Reserve Chairman, then also it is based on my technicals, because my technicals are clearly saying, okay, I have shown you that the weekly chart 90% bearish, daily chart neutral, daily chart of the Dow Jones bearish, okay, daily chart of the Dow futures bearish. So the trend is set, the trend is bearish. Okay, and it is always advisable, okay, if you're trading in the stock market for some good time, then it is always advisable to go with that trend. Even if you have to wait for 1, 2, 3 or 4 days or a week, then wait, but go with that trend. Okay, not against that trend. But if you cannot hold your horses, if you want to make money, okay, even in this the bullish trend, then I would advise you to use a tight stop loss, very tight stop loss, and accept whatever there comes. If there comes profit, capture the profit. If there immediately, okay, if there comes losses, then do not go for your the heavy losses. Just accept whatever losses are there, small losses, and just close that trade. Okay, simple. And use this opportunity, okay, to go bearish. And if you are my YouTube community member, okay, then on the daily basis, I will tell you that where exactly, okay, we are expecting this the downward, okay, where exactly we can expect that it is going to give up. And guys, there is one more thing, okay, if the market manipulators, if they push this S&P 500 higher, if they really want to build, okay, this a trap, that is something that we have seen, okay, generally, okay, most of the times, okay, before the recession actually begins, okay, before means when there comes in a very heavy fall, okay, then they give unexpected movement, okay, just to build a perfect trap, okay, that will trap not just the retail traders but also the technical traders, okay. Because it will simply force the technicals to change, and then the technical traders will think, okay, now it is now the trend has changed. But okay, that is not the case, because when we study the recession or the correction, okay, historically that comes after 10 years, okay, or 20 years, or after 5 or 6 years, okay, then this has happened, that there comes an opposite movement, okay, for no reason, for absolutely for no reason. This opposite movement comes beyond the expectations, beyond the math, beyond the technicals, beyond the guidance. Okay, means everything. Means that is simply illogical trend. Okay, in that case, we have this a trend line, and if you connect, okay, this a trend line, then you will notice that if it want to move up, then 40 around here 4028 here 4029 4025. Okay, that is there. This means that if they want to give it a bullish push, okay, in that case 4025, approximately 4025, okay, they will be okay giving this the push, okay, around to that, means simply to the zone of 4035 in simple terms. Okay, so even in the best case scenario as of now, okay, means even in the best case manipulated scenario, okay, because 4035 can come into the picture only and only if there comes manipulation. Without manipulation, this is out of the picture. Okay, so you should also be aware of this trend line that is there around 4025 or the zone of 4035. And guys, if you have any questions, okay, and guys, if you want to ask any questions, in that case, feel free to comment, okay, and I will try to answer your questions. And guys, if you want to get these the daily updates, the daily analysis of the S&P 500 from Monday through Friday, then you can join my YouTube community. I have given the link in the description of the video and also in the comment section. And it's not just only about the daily S&P 500 analysis and update, but also about the stock market opportunities. So I give minimum 5 to 10 opportunities every week. So guys, once again, if you have not yet subscribed to my YouTube channel, then please subscribe to my YouTube channel and click on the bell notification icon. So guys, this was, and guys, if you have liked this video, then please hit like. So guys, this was my S&P 500 weekly technical analysis for the week of March 27th, 2023. That is from March 27th, Monday through March 31st, Friday.